Hi, everyone. It's Dr. Steph. I'm an assistant professor at the University of Toronto Faculty of Medicine, where I teach financial literacy and transition to practice. I'm also on Instagram and YouTube at Breaking Bad Debt. Today, I'm joined by my co-lecturer, Dr. Mark Soth, who is an ICU doctor that runs the Loonie Doctor blog. This is the second video of a series of videos to help learners understand the basics of investing, taxation, and incorporation. Today's topic is part 2 of ETFs Made Simple, where we compare the 4 big companies, BlackRock, BMO, Horizons, and Vanguards, all in one, or asset allocation ETFs. Which account are they best suited for and how they compare in fees and tax drag?
Great. So this is just a follow up from the talk that we did last time, where we talked about why would we use asset allocation ETFs. And we're going to go through some of the major ones and a little bit of a comparison of them. So just the preceding video of this one was went from kind of the beginning to the end about some of the basics of investing. And so we talked about asset allocation. We talked about using mutual funds versus ETFs and what asset allocation ETFs are, how they rebalance and why that's important. And went through some of the pros and cons of using those types of asset allocation ETFs, along with some of the evidence behind that. So that was the preceding video that we've made. So if you haven't watched that, I'd encourage you to have a look to kind of see the background to what we're going to be talking about today. The agenda I want to cover today is they're going to talk about the big 4 providers of asset allocation ETFs. We'll talk about some of their offerings and the allocations that go with that. And I'll do a bit of a deeper dive into what some of the equity mixes look like, some of the different bond mixes. And then I'm also going to do something which most people don't do, is talk about the fee and tax drag of the different asset allocation ETFs, because that actually involves some calculations. So a lot of people would actually just kind of skip over it, but it's one of those things that's predictable that we could use as part of our consideration process. And then I'll finish up with what the bottom line is. So first, my disclaimer, I am a physician. I'm not a financial professional. I don't advise or recommend any specific financial products or services. My main goal is to educate other people about how to take control of their financial health. And none of what I say is a specific bit of financial advice or a recommendation. So I'm just trying to provide information that you can use to then make your own decisions with. And my conflicts of interest, I do run the Loonie Doctor blog. As previously mentioned, this is a personal finance and investing resource that I've been putting together to try to educate people, not just physicians, but really all high income professionals. Costs me money, but I enjoy it. So I do have a bias towards that resource. I'm also a Q-Trade partner. So I've been mentoring people with DIY investing for a number of years, which I do with colleagues. And I don't charge anything when I do that, but I do get a nominal referral fee when people use Q-Trade link from my site at no cost to them. So that is a conflict of interest. So into today's niche here, we're going to talk about asset allocation ETFs. There's actually becoming more and more of them because they're a very popular way to invest now for good reasons, as we mentioned in our last talk. So Vanguard is the biggest company that first came to market with these that I'm aware of. They're one of the big providers. And there's also BlackRock iShares, Bank of Montreal, and Horizon ETFs. These are the 4 big companies in Canada that provide these ETFs. There's other smaller ones as well. There's Mackenzie Investments has their version. TD now has their one-click ETF portfolio. Fidelity have their versions. But these are really kind of the big name players. So this is what I'm going to stick with for today. And you'll notice they all have these 4-letter symbols, and those are the letters that was called the ticker symbol, which is what you'd enter into your discount brokerage when you're looking to buy them. And they're all on the Toronto Stock Exchange, so they're Canadian listed ETFs. So if you're looking for the Vanguard all equity one, it'd be VEQT, for example. And you notice that they all have very similar names. So Vanguards all start with V's, BlackRock all starts with X's, and BMO all starts with Z's, and then the other letters kind of give you a hint about what they're like. So EQT is all 100% equity. GRO is growth, which is usually 80% equity, 20% stocks. BAL is more of a balanced mix of stocks and bonds, and then conservatives has a higher mix of bonds in them. So they all have a similar nomenclature. So just to unpack that a little bit more, what you do is you pick your asset allocation that would be suitable for you based on your risk tolerance, which we talked about in the previous episode. And then you could select whichever flavor of asset allocation ETF most matches that. So BlackRock, BMO, Vanguard, or Horizon, they all have a 100% equity version. The conventional ETFs, which would be BlackRock, Bank of Montreal, and Vanguard, have an 80-20, 60-40, and 40-60 version. The Horizon ETFs are a little bit different, and I'm going to talk more about that later. They're what's called a corporate class structure ETF, so they're not really the same as the conventional ETF. And they have a 100% equity version, but then their other versions are 70-30, which is their in-between version, and then 50-50 is their conservative version. So you could mix and match those, or you could find other ways to mix and match. For example, if you wanted to have the Horizon ETFs and have 80-20, well, you could buy 80% as HGRO and 20% as their bond ETF, which is HBB. So I haven't shown that here, but that would be an alternative, or you could mix different proportions of it. This slide, I just want to go over a little bit about the different companies that are running these ETFs. One of the big concerns people would have is what happens if the company goes bankrupt, or what happens if they decide to shut down the ETF. I mean, with the bankruptcy issue, it'd be very unusual for a large company like this to go bankrupt. They actually hold underlying assets. And even if they did, well, you still actually hold the underlying stocks and bonds that are held by all the ETFs that you have. So that's actually a separate piece of property from their business structure. So that would still all exist. So that part to me is not so much of a concern. And the other thing is, if we had a major failure like that, it would probably mean that we were in financial Armageddon. So there'd be, anything on paper would probably be in trouble. But I really don't see that as being much of a risk. These are all pretty large companies, and you still hold the underlying assets. But what happens very commonly are ETFs are shut down by companies. And the reason why an ETF would usually be shut down is because of lack of interest or high costs. So that most commonly happens with niche ETFs that are just for a small little part of the market, particularly one that's difficult to trade. So the costs are high. And that's not really what we're seeing with asset allocation ETFs. These are very popular products. So it would be unusual for them to want to shut one down. They're quite popular revenue streams, and it's not a lack of interest. In fact, it's the opposite. They're quite popular. So that I don't think is an issue. And then on the cost side, they're all trading really large liquid markets. So the cost of running them isn't too bad. It's an easily traded area. And usually they actually just hold other major flagship ETFs of these ETF companies. So it would be unusual if they ever decided to shut one of these down. Now, the other part of that, of course, is, how important is this to their business? You can see, Vanguard is a huge company, and they've got $2 billion worth of assets just in the VEQT version. BlackRock is also very large with billions of dollars in assets. Horizon's smaller, but in the hundreds of millions of dollars in terms of their assets. But this is one of their core businesses. The Horizon's main product is ETFs, so it's not like it's something that's unimportant to them. It's their main mode of business. Bank of Montreal is another large company. ETFs is one small part of their business, and the reason why the numbers here for the Bank of Montreal asset allocation ETFs are smaller, like in the millions of dollars, is because they're relatively new to the market. They haven't been out as long, so they're not haven't had as much time to collect other assets as the other funds have.
And out of curiosity, a common question people might ask is, does the size of the ETF have any importance in which one to choose, or it shouldn't really matter?
It shouldn't really matter. The main reason I would think about size are for two reasons. One would be, is this likely something that's going to be shut down because the company just decides to close it just because no one's interested in it? That would be the one reason. The other consideration would be is if trades with very thin volumes, and particularly if the underlying ETFs trade with very thin volumes, then you might have some liquidity problems, where if you try to make a huge purchase, you might have what's called the bid-ask spread, which is the difference between what person's willing to pay and what they're going to pay, might be a bit bigger because market makers make up that difference. But the issue with these ETFs, they all actually hold underlying ETFs that trade in large volumes. So that is not, even if the ZEQT trades with a relatively small volume in a day, the ETFs that it holds underneath that trade in pretty high volume. So it's not like they have to go and do something challenging to construct that unit of the ETF. So it's relatively minor factor. It's very hard to measure it. I don't think you could really measure it, but I wouldn't see it as being a major factor.
Yeah, and that's a good point, because often people will see like, oh, well, what if I want to buy more than just 1,000 of ZEQT a day, right? When in fact, there's other factors that you're going to cover later on in your slides that we should consider when buying the ETF, not necessarily just the daily volumes.
That's right. Yeah. If you're trading in individual stocks, it might be a bit different. An individual stock that has a very low volume is going to have potential for liquidity issues. So they could have a bid-ask spread, that problem, if you're trying to buy and sell something, particularly if it's really volatile. So you don't want to get caught in that situation. But with these ETFs, they're large and they're liquid, and the underlying assets are also large and liquid. So that's not going to be a concern. I'd be more interested in the other underlying characteristics, which we're going to talk about. So the next part I wanted to talk about was a little bit about what is held within it. So I mentioned that it holds underlying ETFs that are actually pretty large and liquid. So just as an example up here at the top, this is the equity allocation. So if you were to buy a 100% equity version of any of these ETFs, this would be what it holds within it. If you were to buy the 80-20 version or the 60-40 version, it would be 80% this and 20% the bond allocation. But it's important to know what actually it holds underneath that surface. So for example, with the equity allocation, the BlackRock, Bank of Montreal, Vanguard, and Horizon ETFs hold a certain percentage as Canadian versus other countries. And what they do is actually hold another ETF. So the BlackRock holds XIC, which is one of their Canadian coverage ETFs. Horizon holds HXT, which is their one that covers the TSS 60. And then Vanguard, BMO, they all kind of hold a bundle of their own ETFs. But what are the important features with that? One is what percentage is allocated to Canada, and the Canadian market is only about 3% of the global market, but most Canadian investors actually overweight ourselves to that slightly, and there's actually a reason for that. There's several reasons. One is that eligible dividends, which are dividends paid out by Canadian companies, that have a bit of a tax advantage. So there's that tax efficiency part of it. We also buy and sell things in Canadian dollars. And, the reason why we're investing is so that someday in the future, we can spend that money. And if it's invested in Canadian dollars, then you don't have to worry so much about currency risk. So the Canadian dollar fluctuates up and down in value. That could add volatility and risk to your portfolio if you're spending in a different currency. But if it's in our currency, that kind of goes away. So that's another purported advantage. Now, there's a couple other points that I would make here that's important. One is that you can see the BlackRock, Bank of Montreal, and Vanguard all hold what's called an all-cap index underneath. So that has large and small companies in it. Whereas the Horizon ETF holds the TSX 60, which is the 60 largest companies in Canada. And in Canada, that really means it has a large cap and a value tilt to that. And what do I mean by a value tilt and a large cap tilt? Is that there's different factors that can influence how much a company or a group of companies returns over the long run. So that's what's called factor investing. And one of the big factors is the size of the company. So smaller companies are inherently riskier. And as mentioned previously, risk and return are very strongly related. So you'd have a higher risk and a higher return over a long period of time with small companies compared to large companies. So even though they make up a very small part of the market and would be a very small part of those ETFs, they are missing from the Horizon lineup. Now, over long periods of time, that small cap premium is probably around 1% per year. And that's found around the world. If you look at different markets, it's ubiquitous. Although I will say in Canada, that's not been historically as strong of a signal for small cap in Canada. And the other factor is the value factor. So value means that the company has a low price relative to its income stream and its assets, that as opposed to growth, which means it has a very high price for the shares compared to its income stream and its assets. So people will buy a growth company hoping that it's going to grow into those, grow into that income and into that price, but it's not there right now. So over long periods of time, value companies have outperformed growth, although over the last decade or so, growth outperformed value, although we've seen that change kind of over the last couple of years. But over long time frames, that would be another factor that would be expected to do a bit better. So the rising ETFs don't have as much of the small cap tilt, but the large companies have a value tilt to them. So there's a bit of an advantage and a disadvantage there. And that holds out through the rest of their asset allocation. So here's the US allocation, and the first bar here at the top, you can see the conventional ETFs again are very similar, where they all around 45%-ish in terms of US. The Horizon one has a bit more US, probably at the expense of the Canadian side of it. And again, the main difference I would point out here is that the Vanguard has slightly more small cap, which we talked about, or mid cap, and the Horizon products again are large cap based, so they don't have that small cap exposure, and that holds true with their exposure outside of Canada as well and outside of North America. So the Horizon version has large cap, whereas the other versions are all cap. So both provide, all of these different ETFs provide a lot of diversification around the world. And if you add up the number of companies held, it's many companies regardless. But there are some differences in how the Horizon products have that value. They have a bit more of a growth tilt and a bit more of a large cap tilt, which is not what you would want if you're looking at factor investing. Those changes are actually relatively small compared to the size of the total allocation. I actually did the math, and it works out to be like an expected difference of maybe 0.15% per year in terms of the factor weighting. So it's relatively small, but it is there. I think people get worried about it, but when you do the math, it's probably a small factor, and you'd have to consider that also against the tax efficiency, which we'll talk about later. If I were to just pick based on the allocation of the underlying holdings, then the conventional ETFs to me have an advantage because they have a small cap, bit more small cap, and they have less growth tilt, and small cap and value tilts are advantageous in the long run. So I think to me that's a disadvantage of the Horizon funds.
Yeah.
The question is, is that made up for by the efficiency of their underlying structure, which is a bit more complicated. So we'll talk a bit about that in this a bit later. Over to the bond allocation side, this is a much less complicated and probably a lot less exciting for people. That's okay. The reason why we hold bonds in our portfolio is to try to stabilize the volatility and to counterbalance all of that risk we're taking with our equity, right? So what we want to have in bonds is we want to have stable bonds. And that's, if you look at the allocation between the different ETFs, they use different ways of holding it, but they're largely holding government bonds, which is what you'd want, because government bonds are the most stable and they have a zero or negative correlation to equity. So that means they're going to smooth volatility the best against equity. So you can see that they hold a lot of government bonds. The Blackrock and the BMO versions do hold some corporate class bonds. So Blackrock has some short duration corporate bonds, and short duration is less risky. And they also have some US corporate bonds as well. So BlackRock has some corporate bonds mixed in with the government bonds. The Vanguard has the total bond universe, which includes some corporate bonds, And Horizon has the Canadian bond universe, which also includes some corporate bonds. But even within those markets, the vast majority of the bonds are government bonds, which is what we'd really want to have. A couple of the other differences, the Vanguard version holds non-North American bonds, whereas the other versions, just the BMO and the Blackrock versions and the Horizon version, just hold Canada and the US. So I guess on the one hand, you gain a bit more diversification around the world in terms of your bonds, if that matters to you. But on the other hand, that also introduces some withholding tax issues. So I don't know whether it's worth it or not. For me, Canada and the US bonds are probably sufficient for what I'd want for the role that I'm planning for my portfolio, but that's something you can decide for yourself.
And some folks might ask a question about this slide about the Canadian hedged bonds. How important is the hedging when it comes to, like, let's say, currency risk, for instance?
Yes, so I was going to mention that the Canadian, you notice that all of the US and non-North American bonds that are held by these funds are Canadian dollar hedged. And that's really important because what happens when things get risky is that's when bonds go up in value and your stocks go down in value. And what you want to have happen is that the bonds going up in value helps you to dampen that downdraft from the equity. But the other thing that happens when there's risk out there is that the Canadian dollar tends to drop. So the Canadian dollar is considered a bit of a risk currency because of the way it's tied to commodities and everything else. So what you don't want to happen, things get risky and your bonds don't go up in price as much because they're priced in a foreign currency that the Canadian dollar is also dropping against. So by hedging against that, it helps to get rid of that currency risk that's there. So we want bonds to smooth our volatility, and by hedging them against the Canadian dollar helps them do a better job of that by taking the currency risk out of it. The opposite is true actually with equity. So that's why you'll see the equity side of the portfolio is not Canadian dollar hedged, because when equities drop, the US dollar tends to get stronger, which, if it's priced in US dollars, is a good thing for us because it helps to dampen that downdraft that you see. So it helps to dampen that volatility. So equities you'd want to have not be hedged, and bonds you'd want to be hedged against your currency. So these funds do that automatically. And it's part of the thought that goes into building them. Now, the other point that I'd make with the allocation here is that the other difference with the Horizon, because it's the corporate class structure, is these other bonds are all going to pay interest, which is going to be highly taxed, whereas the Horizon version is corporate class. And what that means is that they have a group of funds together in a company, and they can use the expenses and the income to offset each other. So what happens from a functional standpoint, and this is pretty complicated, so we'll actually do a completely different video on this, but the functional effect is that instead of paying out interest, it would just become accruing capital within the fund. So you'd have capital gains instead. And capital gains are very tax efficient because you don't pay the tax on them until you realize the gain by selling it. Whereas if you get interest, you owe tax on that in that current tax year. So you have to pay tax right away. And interest is taxed fully as income, whereas capital gains are taxed at half that rate because of only half of the capital gain is taxable. So this is the underlying principle behind why the corporate class structure from Horizon is tax efficient. One of the things that people I think understand that fees affect performance. We talked about that in our last talk. And so you can't predict whether markets are going to go up or down, and no one knows which little slight variation of asset allocation is going to do better than another. So that's why I would not really obsess about small differences between the funds. But you do know that fees are pretty predictable. Those are going to be charged no matter what. So one of the issues comparing the fees, the BlackRocks and BMO are about 0.2% per year in fees. So that's what I call fee drag, because that's whatever your return is, it's going to decrease by that 0.2% per year because of the fees that are embedded inside the funds. Vanguard's a little more expensive at 0.24%. And the Horizon products, the management expense ratio, or MER, that they put on their site is lower. But when you're looking at the fees of a fund, it's actually not just the management expense ratio. There's trading costs as well. And when you have the trading costs together with the management costs, that's actually called the trading or the total expense ratio. And when you add in the trading costs, which for the Horizon products includes swap fees and other things, it ends up, when you add it all together, being around 0.22% a year. So I went into, they're now actually starting to present that a little more clearly on their site, but before I had to kind of dig for it. So when you look at the fees, the reality is they're all very, very close. And I don't know that I could really pick one over the other. Now, the other thing that's predictable in life is taxes. We're going to know that we're going to have to pay taxes no matter what. So that's what I call tax drag. So this is going to be the tax that's due on the income that the fund produces. So whatever the dividends and interest are that are paid out, that's what I'm talking about with tax drag. I'm not talking about capital gains tax down the road. That's a different thing. This is tax that you owe every year that you're owning the fund because of the income that it's paying out to you. Now, this is in a tax-free savings account, and I'm just showing the all equity and the 80-20 stock to bonds ones because those are probably the most commonly ones that are used. But if you want to see the full breakdown of all the different types of funds, that's on my website. But here in a TFSA, you can see there is still some tax drag, and you're thinking, oh, well, it's a tax-free savings account. How could there possibly be tax on it? But the reason why there's some tax in there is because there's foreign withholding taxes that are charged on dividends for foreign countries. And within a tax-free savings account, you're not able to reclaim those foreign withholding taxes. You can reclaim most of them in like a personal taxable account, but within a TFSA, those taxes are essentially lost and non-reclaimable. It's a very small amount. I wouldn't be obsessed about it. It's about 0.2% a year. It's less in the Horizon structure because the Horizon ETFs use what's called a swap, which is a special financial contract. So instead of holding the underlying stocks and collecting their income, they hold a contract with a bank that holds the stocks, and they don't have to collect that income directly, which also means that they don't have to pay foreign withholding taxes. So that makes the Horizon product slightly more tax efficient. But as I mentioned earlier, that's a difference of maybe 0.14 or 0.1% a year, which if you're to think about the fact that it doesn't have as much value and it doesn't have as much small cap in it, that probably to me comes out in the wash. It wouldn't be just the tax efficiency alone there. So I really see no advantage of holding one type of these ETFs against the other in a TFSA. I think they're all pretty much on even footing. And the same really applies to an RRSP. There are some slight differences in foreign withholding taxes within an RRSP. But again, if you look at the actual fee and tax drag between the different funds, it's about 0.4% in the conventional ones and about 0.3% in the corporate class all-in-one ETF, which really I think is within margins of error, and for the Horizon fund within some of the factor tilting differences. So again, I would see no real advantage of holding one thing versus another within an RRSP. Now, in a personal taxable account, taxes take on an entirely different role. So what I've done here is I've given a little bit more information. So just to go through the Blackrock example, so XEQT, the fee drag is about 0.2% a year. Foreign withholding tax drag is 0.01% a year because in a personal account, you can get most of that back. Canada has tax treaties with most of the big developed countries that they're able to get some of that back. The dividend yield, which is a mix of dividends and eligible dividends and interest, is about 2.3% a year. And I did this with $100,000 of Canadian income in Ontario, and that would have a tax drag of 0.6%. So the total is around 0.84, 0.85%. You can see between the conventional ETFs, that's really very little difference, but the Horizon ETF is still 0.31%. So someone making $100,000 a year may save 0.5% a year using a corporate class structure compared to the conventional structure. And that may be starting to get into the range where you might be willing to accept some of the other risks of that underlying structure and some of the potential factor deficiencies, basically. So, and of course, the higher your personal income is, the bigger a difference that's going to make. Now, corporations are much more complicated the way that corporations are taxed. So we can talk about corporate taxation in another talk, and I think Stephanie's done some work on that already, and we'll probably talk some more about it later, particularly with investment income. But there's a number of safeguards in place within the tax system that they're there to prevent us from just making our corporations into giant passive income machines. So one of the mechanisms that's in there is called refundable dividend tax on hand, or RDTOH. And what happens with that is basically when you have investment income in a corporation, it's taxed right up front at the close to the highest personal rate, around 50%. And what happens is when you pay the money out to your corporation as a dividend and then pay personal taxes on it, then some of that tax gets refunded to the corporation. So what it functionally does is it taxes it up front, and your corporation doesn't get that money back until you pay personal tax on it anyways. So it prevents us from just having a bunch of money producing income in there. That's the design of it. Now, the reality is most of us pay some dividends to live on, so we keep that money flowing, and our corporation can be relatively efficient from that standpoint because it gets that money refunded back, and we're taking the money to live on anyways. So it's not like we're paying extra taxes on it. We're just paying our share of taxes. So it's usually not a big problem. But when you do add that corporate tax system together and your personal tax system together, there is an inefficiency there. So you end up paying a little bit more tax than you would have otherwise. So what I've done here is I've shown the tax drag in Canadian corporation of the different funds if it's running efficiently. And that means that you're paying out enough dividends to release that refundable tax and keeping things going efficiently. And you can see with that, the tax drag for the conventional all-in-one ETFs for all equity is about 0.6% a year. And with the Horizon funds, about half that at 0.31% a year. So it's a bit of an improvement, but I'd say it's sort of moderate. Now, where it could make a big difference in a corporation is if your corporation starts to become inefficient. So if your corporation is starting to generate a lot of passive income so that it's getting that high tax collected up front, but that you're not paying it out in dividends because you don't need the money to live on, and then it's having that higher tax rate, that's where, or you end up paying more taxes to take the money out than just the collected tax up front. That's when a corporation can become inefficient. And that's where having something that's not paying passive income is much more efficient. So you can see in that situation where you have a trapping of the refundable dividend tax, and Stephanie's got a video where I spoke a little bit about that on her Breaking Bad.
I'll link that above and in the description below.
Perfect. Yeah, that's great because it's kind of a complicated topic, but it can happen, and it can happen when your corporation gets a few $1,000,000 in it, particularly if you're not spending a lot of money. That's where it really tends to happen. But that makes a big difference. The tax drag at that point is about 1.34% per year. And the Horizon, of course, because it's not producing income, is still 0.3% a year. So if you're having a corporation that's getting large and you don't really spend a lot of money personally, having that corporate class structure reduces the drag of taxes each year. And then when you do need money, you can choose to sell some of it, realizing capital gains. And capital gains get passed out very, very tax efficiently from a corporation. So that's where it could have a large advantage. And that advantage could become even bigger if you start to get into trouble with the active passive income tax limits with the corporation. So corporations making over $50,000 a year of passive invested income, depending on how much business income they earn, start to get a major tax increase. So what's the bottom line? The bottom line, I would still say, is the most important thing is to pick the right asset allocation. So what's your risk tolerance and your risk capacity? Choose the right flavor of asset allocation ETF. That's the most important thing. The next most important thing is to also get invested with it. So don't fiddle around thinking, worrying about a 0.01% difference between one ETF versus the other. It doesn't really matter. Pick the right one and get invested is probably the most important thing. The Blackrock iShares and the Vanguard ones, which are the X's and the V's, those are the largest ETFs, but I also would say that the other companies are large and invested in what they're doing too. The Blackrock fees are slightly lower than the Vanguard fees, but it's a small difference. The tax drag amongst all the conventional asset allocation ETFs are very, very similar to each other. I wouldn't make a big difference between them. The fee and tax drag for the Horizon products, which are the corporate class asset allocation ETFs, are much lower. In taxable accounts, they're only a little bit lower in the tax sheltered accounts. And because of the different factor exposure that they have and the other risks that are associated with them, they're probably their main usage would be in tax exposed accounts as opposed to the registered ones.
All right. Well, thank you so much, Mark, for kind of going over each of the different types of asset allocation ETFs and what types of accounts to put them in that might be advantageous from like a tax or a fees perspective, for instance. So in our next talk, we will be talking about incorporation and the difference between whether we should take a salary or a dividend for the corporation. Thank you for watching, and don't forget to like and subscribe.